Greetings, and welcome to tonight's Market Deep Dive. I'm your host, Emily, and tonight, we're peeling back the layers of what many call earnings season. It's that time every quarter when publicly traded companies throw open their books, revealing their financial performance, or at least the version they want you to see. For investors, it's supposed to be a moment of truth, a chance to gauge the health of companies and the broader economy. But is it really that straightforward? Or is there something more lurking beneath the surface? Earnings season, on the surface, appears to be a period of heightened transparency. Companies release their financial reports, analysts dissect the numbers, and investors react, or so the story goes. This period, typically occurring every 3 months, becomes a pressure cooker for the stock market, often triggering dramatic price swings, reflecting the collective hopes, fears, and sometimes the carefully orchestrated narratives of market participants. But what if these swings aren't just organic reactions to earnings news? What if they are part of a larger, more intricate game? Let's start with a common piece of advice you'll hear. Don't chase stocks that have already jumped before the reports come out. Sounds reasonable, right? The logic is simple. Many stocks see a surge in price leading up to earnings announcements, fueled by investor anticipation of positive results. Everyone wants to get in early, hoping to ride the wave of good news. But seasoned market watchers often warn of a classic buy the rumor, sell the news scenario. The anticipation, the whispers, the speculation, it all builds up the price, sometimes to unsustainable levels. Then, the actual earnings are released. And if they don't exceed the already inflated expectations, or if there's even a hint of bad news buried in the report, the stock price can plummet faster than a lead balloon. Think about it. The market is driven by expectations, not just reality. A company might announce increased profits, but if those profits are just a hair below what analysts predicted, or if future guidance is less optimistic, the stock can get hammered. It's like a magician's trick, all smoke and mirrors, designed to play on your emotions, your fear of missing out, or FOMO, as it's often called. Investors, especially those new to the game, the so-called F0S, can easily get caught in this trap, jumping on the bandwagon just as it's about to roll downhill. They see the price going up, they fear missing out on the uptrend, and they dive in, often at the peak, instead of blindly chasing these hyped-up stocks. Experts suggest a more cautious approach. Look closely at the stock's price movement before the report. Has it already priced in all the good news? Is there any room left for further gains? This requires a level of skepticism, a willingness to question the prevailing narrative. Ask yourself, is this rise justified, or is it just manufactured hype? Depending on your analysis, your strategy should be clear. Hold, sell, or maybe, just maybe, stay on the sidelines and watch the drama unfold. Sometimes, the smartest move is no move at all. Patience, in this game, can be your greatest weapon. Now, let's debunk another myth. All stocks go up during earnings season. That's simply not true. In reality, only a small fraction of stocks experience significant upward movement during these periods. These are usually the market leaders, the blue chips, companies with solid financial foundations and a track record of consistent growth, quarter after quarter. Think of them as the reliable players in a volatile game. The vast majority of stocks, however, show a much more mixed picture. Performance becomes highly differentiated, depending on the quality of their earnings reports and, crucially, investor expectations. Some stocks will rise, some will fall, and many will simply drift sideways, caught in the crosscurrents of market sentiment. Experts often recommend focusing on sectors with positive earnings cycles in the current economic climate. Sectors like banking, retail, steel, or securities, for example, might be in a sweet spot, benefiting from current trends. But even within these sectors, careful selection is key. Not all banks are created equal. Not all retailers are thriving. This is where digging deeper becomes essential. Following the earnings release calendar is also crucial. Knowing when a company is reporting allows you to anticipate potential market reactions and position yourself accordingly. If a stock jumps after a positive report, accompanied by high trading volume and a breakout above technical resistance levels, it could signal genuine institutional buying, smart money entering the game. But even then, proceed with caution. Volume can be manipulated. Breakouts can be fake-outs. Always, always, question the narrative. And speaking of narratives, let's talk about reading between the lines of those earnings reports. A company might announce increased profits, and headlines will scream, "Record earnings." But don't be fooled by the surface numbers. The market is a sophisticated beast. It doesn't just react to current results. It prices in future expectations. And the gap between reality and expectations is what truly drives stock prices. A company can report profit growth, but still get hammered if the results don't beat or significantly exceed. Market forecasts? It's a game of managing expectations, and sometimes deliberately underpromising and over-delivering, or conversely, setting the bar high and hoping to just clear it. To avoid being blindsided by a seemingly positive report that sends your stock tumbling, you need to go beyond the headline numbers. Compare the reported results against previous forecasts. Did the company meet, exceed, or fall short of expectations? Then delve into the details. Analyze key metrics like profit margins, operating cash flow, and the quality of earnings. Is the profit growth sustainable? Or is it a one-off event? Is the cash flow healthy? Or are they relying on accounting tricks to boost the bottom line? Don't just focus on net profit after tax. That's just the tip of the iceberg. Many times, companies report profit increases, but their stock still drops because they missed expectations on other crucial metrics, or because the market simply didn't believe the numbers were sustainable. For a truly comprehensive picture of a company's financial health, you must examine the balance sheet. Look at key items like inventory, accounts receivable, debt, and equity. Are inventories piling up, indicating slowing sales? Are accounts receivable ballooning, suggesting trouble collecting payments? Is the debt level manageable? Or are they drowning in obligations? How strong is their equity position? Also, scrutinize related party transactions. Are there any unusual dealings with affiliated companies that might raise red flags? If you spot any abnormal fluctuations in these balance sheet items, be wary. Investigate further. Understand the reasons behind these changes before making any investment decisions. These details, often buried in the footnotes, can tell a very different story than the headline earnings numbers. They can reveal the true, often hidden, health of a company. Now, let's talk strategy. Many retail investors, especially those new to the market, often trade based on rumors, emotions, or, again, FOMO. They see a hot stock. They hear whispers of big gains, and they jump in without a plan, only to get caught in the inevitable market corrections. It's like chasing shadows, always one step behind the real players. To trade effectively during earnings season, you need a clear strategy. Define your entry points, your exit points, and your stop-loss levels. Have a plan, and stick to it. Discipline is paramount in this game. Crucially, avoid excessive margin, especially if you're unsure about market direction. Margin can amplify your gains, but it can also magnify your losses, turning a small dip into a financial catastrophe. Technical analysis can help you identify optimal entry points, but fundamental analysis, understanding the underlying business, should always be your foundation. Technicals are just tools. Fundamentals are the bedrock. For long-term investors, the focus should be on companies with stable business models, those less susceptible to short-term market fluctuations or seasonal trends. Look for companies that can weather economic storms, companies with durable competitive advantages. Earnings season for them is less about short-term trading opportunities and more about long-term validation of their investment thesis. Do the earnings confirm the company's long-term growth trajectory? Are they still on track to achieve their strategic goals? These are the questions long